You may not know this, but the word mortgage derives from Old French, and it actually translates to death pledge. Now think about that for a second. And basically this means that the debt obligation, the ball and chain that you've been carrying around, won't be cut free until the debt is repaid in full. So needless to say, many of those that have a mortgage have spent countless hours dreaming about how great life would be if this death pledge was no more. So in this video, I'm going to show you 7 ways, and these are things that anyone can do that has a mortgage to knock your debt on the head. Most repayments are set up on a monthly basis, but here you can play a little trick on yourself that you probably won't even notice that will result in you making a full extra repayment each year that you otherwise would not have made. So if you're making monthly repayments of $2,000 each month, that adds up to $24,000 over the year. Now if you split that $2,000 in half to $1,000, but you make these repayments every fortnight instead of every month, that $1,000 over 26 fortnights in the year is going to add up to $26,000. That's an extra $2,000 paid over the year, or a full month's repayment. And the way this works is that there are more than 2 fortnights in a calendar month, a fortnight being 14 days, 2 14s are 28. Most months have 30 or 31 days. So provided you halve the monthly repayment amount, the $2,000 to $1,000, and you make that repayment 26 fortnights throughout the year, you're going to end up making that full extra month's worth of repayments in the year, and you won't even really notice. Okay, so when the RBA cuts the official interest rate, some banks, not all, but some, will automatically drop your monthly repayment amount lower to match the now lower interest rate. Other banks will have to submit a request to do this. The trick with this one is to maintain your usual repayment amount, even if the bank is now accepting less because of the interest rate cut. So if the RBA has cut rates by 25 basis points, which is 0.25%, they will now accept a lower repayment amount. But even if the bank is going to let you now pay, say, $1,950 a month instead of $2,000 a month, keep paying the $2,000. Don't take that $50 down the racetrack each month. Stay strong, because that extra repayment is going to come off the principal each time, and it's going to reduce your interest over the long term, and this compounds and it's going to save you a lot of money. Now let's talk about rounding it up. Why not round up your monthly repayment to the nearest $100? The thing is, you're not really going to notice that less than $100 each month going into your mortgage, but over 20 plus years, your debt surely will notice. So let's say you have a monthly repayment of $2,043. If you round that up to the nearest $100 to $2,100, that is going to make a big difference. And if you can afford $2,043, you probably can afford $2,100. I'll show you an example. If you have an interest rate of 5% and you've rounded up your repayment from $2,043 to $2,100, and you do this on day one when you first take out the loan, so you still have 30 years to go on the loan. Over the life of the loan, this can save you up to $24,000 in interest, and it can wipe 2 years off your loan. It can bring 30 years down to 28 years. If you're lucky enough to get a bonus from work, this is money that you weren't living on before, that you probably could live without, so why not throw it on the mortgage? Got a pay rise? Throw it on the mortgage. If you have a windfall of any kind, or any extra money that's found its way into your bank account, instead of spending on something that you don't really need, why not throw it at the mortgage and buy back your life? It's a known fact that the best interest rates go to new customers. New customers that banks are trying to get onto the hook. Once you're on the hook, you're likely to stay on the hook. For this reason, loyalty isn't always rewarded by the bank, because loyalty is easy money that they don't have to work for. But you can also leverage loyalty to work in your favor. So if you've been loyal, you've been with the bank for a number of years, you've always made your repayments on time, you've generally been a good customer, why not ring them up and ask for a better rate? You may be surprised that they may well agree to your request and lower the interest rate on your loan. Yes, it can be a bit daunting, but you really have nothing to lose on this one. All right, so you've rang up the bank, you've asked for a better rate, but they won't come to the party. So your next option might be to look at refinancing the loan. This basically means you close out the loan with your current bank and take out a new loan with a new bank. There are usually fees associated with refinancing a loan, and there might be conditions such as a minimum loan balance requirement. So you might have to be for a minimum, say, $250,000. But you also have to be aware that you might be losing some features that you're used to when you move it over to the new bank. For example, your new loan might look very attractive with the interest rate, but it might be more of a no-frills product. So you might lose access to an offset account, for instance. So you need to look at what exactly is involved with your new loan compared to your old loan, because you're not necessarily comparing apples with apples here. Also, don't get fooled by a super low introductory rate or a honeymoon rate, because usually when a bank comes out and markets for new customers to put on their loan book, they will advertise a very low rate, which may, after a year or 2 years or whatever, go up to the higher rate, which will be the rate going forward. So you need to have a look at what the interest rate will be once the honeymoon is over, baby. If you've seen my other videos, you might know that offset accounts are one of my favorite things going around. So especially when interest rates on deposits are quite atrocious, offset accounts are fantastic in that they allow you to have your money at call, but also earn a pretty decent rate at the same time. So if you have $20,000 in an offset account and a $300,000 loan, the offset account, being the clever thing that it is, will mean that you only pay interest on $280,000 rather than $300,000. So anything that you save on interest, that lower interest payment means it's going to be money coming directly off the principal. So I've given you 7 ways here, guys, on how to hammer your death pledge into the ground. At the end of the day, there's nothing crazy here that anyone can't do. A lot of it just comes down to paying a little bit more than you have to. Because I'll tell you a little secret, the banks don't want you to pay it down fast. They want you to pay it nice and slow at the minimum rate over a 30-year period, because this is how they make their money. You might actually fall off your chair if you knew exactly how much interest you were paying over a 30-year period. So why not do something for yourself and knock that mortgage off? Remember, guys, the easy path won't get you anywhere. Getting ahead requires hard work and sacrifice. And at the end of the day, it's going to be worth it. Now, if you enjoyed the video, if you learned anything, I'd really appreciate if you can hit the like button. If you want to see more, please subscribe. If you want to continue the discussion, leave a comment down below. Other than that, thanks for watching, and we'll see you in the next one.